Take one, Street Pro Stocks and Markets Podcast, March 31st. All right. Hello and welcome to this week's The Street Pros Stocks and Markets Podcast. You might notice that Chris Versace is not here today. I am Jason Meshnick, and this is a podcast takeover. Chris is in the process of moving, and he will be back next week. And we miss him very much, but he's never very far from us. I've talked to him an hour ago. So I'd like to kick this off by talking about some of the changes to the Pro website. As you know, we were bought back in November by a company called TipRanks. So there have been some changes. The first thing that we did is we migrated to a brand new website, a new platform. The commenting system is no longer open web. We actually have a homegrown system, which is pretty good and is only going to get better because the team that we're working with, our dev team, is incredibly responsive, and they are hardworking, and they want to really make Pro the best that it can be. This is just the beginning, and I look forward to many new great changes for our members. So we'll be taking advantage of our new relationship and partnership with TipRanks. TipRanks also owns The Fly, which many of you are familiar with. I know Sarge, when we made this change, told me that he was already a subscriber to both The Fly and TipRanks. So you know that these are great quality products. And so, yeah, we're going to have lots of great improvements in our product mix in the future. And I think this is an exciting time to be a member, and it's only going to get better. So that said, you'll probably notice that I am joined here today by three of my favorite contributors to the Street Pro. I'm going to ask each of you to quickly introduce yourself and tell us the types of information, the types of analyses that you provide to our members, and then give us a little known fact about yourself. And I'd like to start by the person who has been with us the longest, who I believe is Bob Lang.
Thanks, Jason. Great to be with Lou and Sarge today. Sarge back a long way. I really have been with Street since 2009. So yes, almost 17 years. Off and on a little bit here and there. Was managing a product with Chris Versace called Trifecta back probably about 10, 12 years ago. And then Chris and I got thrusted into managing former Action Alerts Plus portfolio in 2019, and it was a great experience. He's still doing it today, doing a masterful job. So what I do for the subscribers, you guys, what I do is I write some articles each day on technical piece on maybe a position that I'm looking at in the portfolio or outside the portfolio, and I deliver that each and every day. Also help Chris writing some of the roundup on every Friday. It's been a great run. It's been a lot of fun, a lot of turnover, a lot of changes for the company. I'm very excited about what's going on currently. You're a great leader, and I think you're leading us to the promised land here. One of these days, it's gonna really super pay for all of us. So you asked about a little known fact that about us. So I will tell you that some people know this, that back in 2013, I was doing about every month and a half, helping Jim out with Off the Charts, and he liked my presentation. Would see this, so we were doing it for, like I said, every month and a half. And back in 2013, he asked me, to come up with some ideas. And so I know that Jim had bandied about some of these acronyms for stocks, and he still does it today. So I was looking through some of the ideas and the names and some that he likes, and so I looked at Facebook back. I looked at Amazon, one of my favorites. Netflix, also one of my favorites, and then Google. I know Jim really liked Google a lot, so I put together the FANG acronym back in 2013, and Jim loved it. He ran with it. It was one of the best acronyms out there very identifiable. You couldn't go almost a day without hearing some mention FANG. And I know Jay took credit for doing that, but some years later he mentioned that he said, you know what, Bob, it was your idea, I stole it, but it's been a great it's been a great move. And talking about FANG for so long, it was these were four stocks that were solid, and of course, N could have been Nvidia, right? We could have done that, but at the time, Netflix was best. And in fact, if you look at the four names, Jason, Netflix is the far and away the best performer since 2013 February when we put the FANG together. I mean, it's not even close. So Meta is probably right there behind it, and Amazon as well too, right behind it. So yeah, it's been a great run. I think people have forgotten about FANG. They moved their attention to Mag 7, but that's where it started with me.
Yeah, I was going to say, you might even say that FANG, your coming up with FANG was magnificent. As my dad joke for the day. Sarge, let's move on to you, because I think you've been with us since around 2015, 16, something like that.
2016.
Okay.
2016 was the year I laid off Wall Street. You've heard of Wall Street laying off workers, which I participated in a couple times. But in 2016, I became fed up with Wall Street. I walked away. I decided to run my own money, run my family's money. So far, so good. 10 years in, we're still going. I write 3 articles a day for TheStreet Pro. I start out with basically my thoughts at 3 and 4 in the morning, which is market recon, which is really my flagship article, I guess, of the day. My second article is usually a topical stock, whatever stock had great earnings or lousy earnings, or it's just in the news for one reason or another, where I try to fuse the technical with the fundamental and come up with my own hypothesis for the stock. Often it's a stock I like, but not always. And my third article has historically been a stocks under 10 piece, which I used to run that with Chris Versace. You mentioned Chris. Chris and I started that as the stocks under 10 portfolio. We didn't start it, we inherited it. A product called the stocks under 10 portfolio, which did rather well. And then it evolved into a column as all the products at what was Real Money Pro at the time were fused into fewer products to try to simplify things for the customers. That product, which sort of still is stocks under $10, has become what I'm calling the $10,000 portfolio, which I'm marketing to our readers as not a model portfolio. I actually separated $10,000 of my own money, and I am investing that $10,000 as I see fit, trying to do it in a very transparent fashion, and telling the readers what I'm going to do ahead of time so that they can act ahead of me. I go last, so I don't front run my own ideas. And we'll see if I can make some kind of ball of wax out of 10 grand. This is aimed at the newer investor, at the younger investor, at the investor that just doesn't have a lot of dough right now. And we'll see if we can get these folks into the game of investing, into the idea of being involved in the markets, because a lot of them have not been. A lot of them have been disenfranchised. Let's try to franchise them.
Awesome. I love it. And I'm glad you're doing it, and I'm excited to talk about ways that we can highlight it even more and really build it into the product that it can be, because I think it's something that has been lacking on TheStreet Pro, and really is lacking for investors in general, right? This is the kind of resource that people really need. So I'm excited that you're doing it, and I look forward to watching how this grows.
So Sarge, are you going to be managing these new Trump accounts for the young kids going forward? I mean, that's a lot of money that Michael Dell is committed to the young kids. He just puts it all over to you. Will you be managing it?
I'm managing 10 grand, okay, publicly. That's all I'm managing. I have nothing to do with the president right now or anything like that. We've had.
Fair enough.
The funny thing is, a lot of my readers know I went through a divorce, which was finalized about 2 weeks ago. So I was almost all cash for the last 2 weeks while the market got killed. So yes, I gave up half of my dough, but on the other hand, I was in cash when the market got killed. So it's kind of a loss, win loss. I don't know, but our portfolio is down 5% right now. I started it last week.
Okay. Let's in the interest of time, let's move on to Louis. and you can introduce yourself.
Well, I think I'm the new guy on the block, so maybe I should tell you guys a little bit about myself. I have a pretty wide, broad experience set in the investment world. I've been doing it for 30 years plus, and I've been in pretty much a lot of different parts of the street. You know, I was a broker. I was a hedge fund manager. I did a bunch of quantitative analysis. I did a bunch of algorithmic programming before anybody was talking about algorithmic programming, and we were still calling in orders to the futures exchange. Um, you know, and I managed money for very wealthy people at a bank, and I started my own registered investment advisory firm. And I'll tell you, I look at my whole experience set, and I think this is one of the reasons why people kind of a little bit confused about me, like what exactly does Louis do? Like what does he know? What's his specialty? I think my specialty really is the fact that I'm really a global guy. I can see things from a lot of different perspectives. I'm a quant at heart, but I also love the narrative because I know the narrative drives the understanding of a thesis. And sometimes those narratives can take things really far. So what to expect when you read my stuff, it's going to be a little bit eclectic. Sometimes I'm going to talk about something as simple as here's some exchange traded funds that are probably going to work well if we see some change in the Strait of Hormuz. And other times you'll hear me talk about a particular stock like a Hershey, where it's like clearly undervalued and maybe we should be taking a position in this. Or I might be talking about small cap stocks, or I might even be talking about a theme like, you know, hey, you know, these large cap stocks are like overdone. And I do have a little bit of a contrarian bent, but I'm also a trend follower. So it confuses people. Like, what are you, a trend follower? So what I really am is I'm a trend follower when I think things are on a continuation pattern, and I'm a contrarian when I think things are overdone. And so and I'm not always right. So I think that does confuse some people, but to kind of put it into a cohesive set to, you know, for people who are reading my stuff, is that it's going to be eclectic. It's not going to be focused on one different thing because that's how I operate. And when I manage money for wealthy individuals, mostly individuals. And so my strategy is multi-strategy. So I have some absolute return type strategies. I have stock sleeves that have different objectives that are quantitatively driven. And then I also have a beta, you know, element to the portfolio where I don't want to be fully invested all the time, so I can push beta up and down. So, and what that does is that builds a resilient portfolio. So overall, the overarching theme is I'm looking for resilience in portfolios. I don't, you know, I'm a technician, I'm a CMT, I'm also a fundamental analyst, and it just confuses everybody. So hopefully that puts a little bit of clarity about who I am.
I think John Bollinger would call you a rational analyst.
Yes, yes.
And I think the three of you all fall into looking at fundamentals and technicals, a combination of them both, which is why I liked having the three of you together. But sorry, Louis, continue.
That's great. Speaking of John Bollinger, the first paper I wrote back in the day when you got a CMT, you used to have to write a paper. The first paper I wrote was on volatility adjusted momentum. And I used some interesting ideas from John Bollinger's work in the past and combined momentum with it. So I actually saw John Bollinger in New York, and I mentioned it to him, and he developed an indicator that was similar to mine. I said, "Hey, John, did you ever read my paper I did back in 1990?" And he sent me a text back. He's like, "Yeah, but mine's different," and it is different. They are different, but he's such a great guy. Anyhow, so you wanted to know a little bit of interesting things about me. Well, I'm
just one fun fact.
One fun fact, a fun fact. I just picked up, I'm a guitar collector, and today I have delivered a Les Paul Custom that is TV blue, which is it's a first run of this Les Paul Custom, and I'm so excited about getting it because I just wrote this song that I'm about to record, and I need these P90s, and it's like I can hear what I want, and I found a steal for one on Reverb. So there you go. That's a fun fact for you.
Congrats, that's awesome. And Louis, you wrote a great article about a year ago, I think, on guitar collecting and lessons that offers for investors. I will see if I can remember. I will try to link that in here somewhere because it is one of my favorite articles because I love analogies, and I love thinking about markets in different ways. So yeah.
I
All
think it
right.
was
With
called The
that,
Real Gem or something like that.
the real gem. Okay,
Something
I
like
will
that.
find it. Yeah, because yeah, it was a good article and it's worth maybe we'll even republish it as a new one. Um, okay, so let's dig in. I'm going to start off with the elephant in the investor room, I guess. We're all talking about it. So let's just talk about it. On Monday, another one of our contributors, Peter Cheer, who is very much like Louis, very much a global macro guy, thinks a lot about geopolitics. I think geopolitics is really one of his specialties, and that's why I read him on the Street Pro. He wrote about 3 potential outcomes in Iran and what they might mean for the financial markets. So the 3 are, first of all, outright victory in the near term, so under 1 week. You might call this regime change. I'm really, describing what Peter was talking about. These aren't my words; these are his. So he says the government might call this regime change because we've actually killed so many of their leaders. That's actually not going to be necessarily accurate, but it will be sellable and people will read it and understand it that way. Peter thinks that we could literally just declare that we won and move on. And there is some talk about this right now. I think that's what the Wall Street Journal article that Sarge mentioned this morning in Market Recon talked about. What this means for the rest of the world, I don't know, but Peter thinks that this is a 40% likelihood. Okay, the second scenario is a true victory, an outright victory where Iran changes dramatically. The regime is either overthrown or concedes so much that it becomes a normal, quote, normal player in the Middle East. U.S. corporations might be able to establish outposts there, and they become, very much like some of the other countries that we're in. Oil might fall in value, et cetera. He sees this as a 25% chance of happening. This would take significantly longer than this 1 week time frame in scenario number 1. Scenario number 3 is a stalemate. And this would be where the war continues for longer and we don't get a good deal or any sort of true victory. And there will be recession risk around the world. Prices will increase. We'll see, inflation, food, fertilizers, semiconductors, and other things. He sees this as a 35% outcome. I want to ask each of you, and let's just go in the same order that we started with. I know this is probably a hard question. This is not your expertise, but what do you see as the most likely outcome? And maybe it's not one of these 3. Maybe there's another outcome. And what asset class will provide the best risk-adjusted returns for the rest of 2026 based on this? So let's start with you, Bob.
I'll tell you. It's hard to trade markets on rhetoric and political talk and whatever the media is sending you. So if we just, what I try to do is I try to really stay focused in on what the price action is doing in the market. The price action will tell you everything you need to know about the past and what's happening now, and also the future. I know Louis talked about how he blends a mixture of technical analysis and fundamental. And I think he might agree with me that fundamentals often will win in the long run, along with technicals. But short run, we have a lot of inefficiencies, and that the technicals are extremely important, vital, probably the most important thing to look at when it comes to evaluating and analyzing movements of the markets and movement of stocks. So
I agree with that.
That
totally.
being said, thank you. So I would tell you that whatever scenario we have there, it's going to be, I don't think it's 1, 2, or 3. I think it's going to be some sort of hybrid of those 3. I don't know where some of the weighting is in each one of those. I think that it's going to be difficult for the administration to admit they've lost or failed in this mission because they started it and want to finish it with some sort of emphatic victory call. I don't know if that's happened already or it's going to happen, but I can tell you this. What is the market telling me? The market is telling me right now, I mean, the volatility index is down today. It's down 10% today. And that is quite a large move. However, it was elevated coming into today, over 30%. And when the rule of 16 says that when the VIX is at 32 or 31, 32, we're expecting 2% moves on a daily basis. However, so that would be a positive if we see the volatility index continue to come down, dripping down. However, oil prices still up today. So I thought that perhaps maybe with some positive news on the war front, oil prices would be coming down. The crude oil is up near $2 on the WTI right now, so almost to 105. It was up over 106 last night before this Wall Street Journal article came out. So I think the jury is out right now. I think we really don't know. The smoke still has not cleared yet from this, and I think we could be faced with much more volatility here. We've seen the volatility index trending higher over the past 6.5, 7 weeks. It's not like we get a big spike up and right back down again. It's been trending higher, which tells me one thing. It tells me that big institutions are coming in and buying protection left and right and dumping stocks. That's all it is. That's what the market is telling me right now. And until that changes, we're still going to be in this environment of sell the rips and maybe buy the dips.
Okay. And as far as an asset class for the rest of 2026, based on your thoughts here?
I mentioned this in media 5-6 weeks ago, and I know it's had a big run. It's about 50% the past few weeks. I still think crude oil is going to be strong, especially since Iran still has the nuts and bolts of releasing crude oil. If they control the Strait of Hormuz, I think what we heard last night is that we're willing to concede the fact that, yes, they do control the Strait of Hormuz. And if oil is going to have a tough time getting through there, look, they came out and predicted that $200 oil is coming. And for a big supplier like this, they've been at this for years and years and years. You have to not take it with a grain of salt. You have to take their threat seriously about what they see. So I see energy prices, even though it's going to benefit our companies because we're very energy independent now, much more so than we were 10, 15, 30 years ago. But so our energy companies are going to be benefiting. But I do think that oil and energy is where you still can see some value. I think maybe $140 to $160 a barrel is certainly not out of the realm of possibility. It's going to do some damage to the economy, but that's just where I think that's going to go.
Yeah, and when you look at the sector charts, the sector ETFs, the XLE energy ETF is just 45 degrees, marching upwards pretty steadily.
Yep.
Thanks, Bob. Sarge, let's move on to you. Same thoughts.
All right. I do believe we're going to see some extreme volatility in the short term. I think what we have to decide, well, we don't have to decide, what we have to observe and be prepared for is that we don't know where this article from the Wall Street Journal really came from. There's a very good chance that the president or the administration wants us to believe that, yes, they might consider leaving the Strait of Hormuz in Iranian hands and put an end to this war. The equity market's acting like that's the case. The oil market is not. I find that very hard to believe. I think that this may be some kind of misinformation, maybe disinformation, maybe to get NATO to be more of a participant, maybe to try to fool the Iranian military. I mean, speaking as a former Marine Corps infantryman, if I were going to attack in the next couple of days in size, in force, I would try to put the enemy at ease in the days ahead. So I believe that this is probably something of a ruse ahead of a large-scale attack that's meant to bring an end to the war sooner. Whether that works or not, I don't know, but I know the market will react poorly to that. So your opportunity may be coming in the next few days, but right now, I think we should be. Maybe you want to start legging in, as I mentioned, I had been in cash. It's time to maybe start legging in, but it's not time to get aggressive. That time, I believe, is still ahead of us. So I do think geopolitical risk is the height of what to be concerned about for now. But I do think moving forward, this war will be over. Whether we declare victory or actually attain victory, this war will be over in a month or less. We will go back to worrying about whether AI is going to steal our jobs. And we will go back to wondering if the big, beautiful bill is actually going to boost the economy. So those will be the things that we're actually worried about. So I do believe the price of oil will come down as the year progresses, probably within a few months. It'll be gradual, maybe at first. I do believe that technology, not so much software, but definitely semiconductor space, the right semiconductor stocks are a place to be. Financials may or may not be a place to be, depending on whether this inflation is sticky or not. Because if this inflation is not that sticky, and Jerome Powell acted yesterday like maybe it's not, in his opinion, which I did not expect from him, then you might want to be in financials. It's I think the Fed is going to have maybe a little more latitude moving forward. Not that they want to cut rates, but there won't be a pressure to raise rates, and that might be enough for the market, at least for the rest of 2026. So I don't think I missed most of the energy ride. I was only in a few oil services stocks when energy just took off, and they didn't even do that well. So I missed this 40% pop year to date in energy, but I don't think I want to be in energy now. I think energy has either peaked or gotten close to peak. It may go a little higher, but I think that, and it may spike when we have this attack I have in my head that maybe the granddaddy of the war in terms of military aggression. But I do think that things are going to get better as we move into the latter part of 2026, as the administration understands that they have put the midterm elections at risk, so they try to slap a quick band-aid on that problem as far as they see it. So I think that there's going to be an attempt to get the economy rolling, economic activity picking up, and I think that's going to include a rally in the stock market.
I think that's a great perspective. Yeah, and I
Hey,
love that yeah. Go ahead, Bob.
Can I ask Sarge something?
Yep.
Sarge, as a military man yourself, if you were in a situation, maybe making decisions, and you realize that you're in this battle with a country that seems rather emotional and irrational. You've just wiped out a lot of their military, their navy, their leaders, and so forth. And you've got a cornered cat. Is you cannot assume that nothing's on, nothing that they can do is off the table, right? Nothing they can do is off the table. Anything is possible with this country. I don't know. I really don't honestly want to think about the possibilities of what can happen. But how do you hold back, Sarge, when you've got any limitless amount of possibilities here? How can you prepare for that?
As an investor, I would prepare for that by prioritizing cash, staples, things like that for the right now, for the immediate future. As I mentioned, I think we have a brighter day later on in the year, so I don't want to be in staples too long. And I do want to be in growth stocks, X software probably going forward. And I don't think a ground war that involves the invasion of Iran is even feasible. But I do think the surgical control over key parts of the Iranian economy, such as Cargo Island, such as energy infrastructure, maybe seizing their water desalination plants, things like that, things that are cut out for special ops, for amphibious infantry, for airborne infantry, for these kind of troops. I think we might very well do something like that, and that would force Iran into a situation where they had almost no ability to negotiate. That would also involve larger than tolerable U.S. casualties. So I'm a little bit negative on this right now, but from a market perspective and from a military perspective. But I do see the rationale, and I do see a brighter day as long as we can wrap this war up before the end of April.
Yeah.
Okay, thank you. I want to move on to Louis before we move on to our next topic. So Louis.
Yeah.
Let's
yeah. So I'm not a military strategist, but this is kind of, maybe I can just outline how I'm thinking about this. I'm saying, okay, there's three big levers really with this particular situation. One would be oil prices, right? The other would be, is this going to spread? And then the other one would be inflation. I think those are the three biggest levers in terms of overall asset class effects. And then I go back and I go, okay, well, let's look at the historical patterns. And I was thinking about what happened in World War II. The stock market bottomed before, the war. It was clear. go for. You just go down the list, and the market bottoms before it's clear, right? So I think, and then also the other thing that we always know is that volatility increases when people just don't know. So one of the things that I like, and I've been talking about ahead of this really, is adding more to managed futures, trend following, long short, stock, bond, commodity, currency futures type strategies. And those are up, 11%. One of my positions up 11, the other one's up about 7. And that's working well because whenever you have this high volatility, it affects all these other asset classes, and those trend followers are going to capture that. That I do have a meaningful allocation to that. The other thing that I'm doing in terms of how to deal with this is just to have more resilience in terms of the portfolios focusing on quality. I do have more cash as well and treasury bills. I'm also putting some money in variable rate instruments if rates continue to rise. So I want to have a little bit of positioning there. But as far as what the outcome is, the stalemate versus other outcomes, it's hard for me to guess and know for sure. But if you kind of think about it in terms of game theory, it seems to me that the incentives are in place to make this stop sooner rather than later by many parties, right? And so I think we'll probably see some form of just claiming victory. I really do believe that's probably likely. No one's going to get 100% of what they want. And I do. You're already starting to see the Strait of Hormuz open up. I mean, there is oil passing through there. The big overarching thing here is the big power shift between the United States and China. All of that. I think that's the big overarching issue that we're dealing with, and that's a really, really long-term situation. But you asked the question about 2026. So in terms of 2026, I really think managed futures is a good thing. And a lot of people just don't touch that. They don't know about it. But that's an asset class that usually is a big winner in that. And staying with quality. When we have a boom up, I have a portfolio sleeve where I'm focusing just on companies that are high quality in terms of profitability, direct profitability, but they're also starting to have momentum shifts and they are trading at reasonable valuations. A lot of those companies are in the mid and small cap area. They're very highly profitable, and they're also benefiting from in the industrialization shifts that are happening, the supply chain. I'm not going to mention any names right now in terms of individual stocks, but so that is a big part of what I'm doing, and that is outperforming right now. And I agree with being careful with having too much in staples because they'll turn on the dime. I mean, I think today I saw the utilities were turning down. So I don't know that I'm giving you a satisfactory answer, but my approach is not to try to predict that as much, but to be resilient and to think in terms of overall positioning where I can make it as much as possible win-win for the portfolio.
Well, I want to touch on that for a second. If you could quickly give us a name, perhaps. You mentioned managed futures. Are you doing that through an ETF, or are you actually with a professional money manager who's doing managed futures?
So I'm doing both, but I'll mention some of the ETFs that's very widely usable. Anybody can get it. The ticker is CTA. One of them is Simplified Managed Futures, and the other is DBMF. I think out of all of the players that are in there, in that space, those are probably the two best. I like blending them together because one of them is kind of a replicator. They're looking at the overall managed futures index. That's DBMF, by the way, and they manage their portfolio and to track what the trend followers are doing. And then the other one is more classical. CTA is more classical. They'll have more equity exposure, long short, and you put them together and you get a really nice portfolio. By the way, you can put together these portfolios of alternative strategies. If you have alternative equity, alternative fixed income, and then absolute return strategies, and you can get Sharpe ratios that are very approaching 2, and the volatility is about the same as the bond market, and you're outperforming the bond market by almost 3x. And I think that part of the portfolio, that's a good carve out. Having a lot in fixed income right now, I don't think it makes as much sense as having more of these alternative strategies blended together, and not trying to do really a timing. Just I look at it from the standpoint of selecting these strategies that can make sense, that make sure they're non-correlated, blend them together, kind of a combination of maximum Sharpe and a minimum variance type optimization, and kind of a blend of that. And I know I'm using a lot of words that are kind of like jargon, but
I was going to say,
suffice it to say, I'm a little bit of a quant, I know. Suffice it to say that what it's basically trying to do is to give you a smoother ride with a part of your money not in fixed income, and taking some of that off the table from the equity market.
Right. Yeah. When you're talking about Sharpe ratio, you're and a lot of what you're talking about, Sharpe ratio and correlations, the statistics here, you're really just talking about coming up with securities or a portfolio that has solid risk-adjusted returns. So you're not necessarily looking for absolute, right? That's obviously always a goal. You want to beat the market, but this is how can you do so? How can you have strong returns with the least possible volatility?
Yeah, and to be able to
Yeah.
benefit from increasing volatility by using managed futures,
Mhm.
be able to benefit from rising interest rates by having variable interest rate instruments. But I'm not talking about a huge percent of the portfolio, by the way. I'm talking about 20% of the portfolio, in my personal money, as well as for most, like on average for most clientele. And then the other thing I didn't mention was rising dividend type stocks. Those, what's funny is those actually sold off harder than the market very recently, but overall year to date, they've been doing better. Companies that consistently raise their dividends and then also have reasonable valuations in times like this, they tend to do better than some of the other stocks. But I also like I agree with Sarge about the tech stocks and all that stuff. The sexy stuff, I am not opposed to that. I'm definitely not opposed to that. And I mean, and sometimes I use them as bellwethers because I found them to be the best bellwether for the market. If you find, Robinhood starting to sell off, break support, that's telling you the market's about to go down. That's exactly what happened. But I owned it, and that, you see gold coming down right now, for currency related reasons and profit taking and all that. But I kept paring back on gold as it was going up and up and up, really parabolic, keeping the position, still have the position. So I'm not really trying to time all in and all out. I'm more of a probabilistic investor and adjust my position size and stay diversified. That works for me because one thing I learned, and I'll shut up here in a second, is that the market money just doesn't go away. It just shifts, right? And so you got this pie, and it's going from one asset class and one to another. And if you're just only trying to pick one asset class, and you really have to get it just right. And the more money you're managing, the harder it is to do that. With a smaller account, absolutely, you can time the heck out of that thing, and you can really, that's how you make money in the market. But I'm kind of a little bit more in the business of getting reasonable rates of return and preserving it as well. So for those who are interested in that kind of stuff, that's kind of more my speed.
Hey, Louis, can I
Great.
pick your brain a second? I just did like a 10-second analysis on these two, CTA and DBMF. By the way, for the folks at home, DBMF yields 5.5%, so that might be interesting to you. But do you find, I mean, I don't know if I'm just eyeballing the chart wrong, but do you find that these funds tend to move ahead of the broader market when on trend reversals? They beat the market by about 2 to 3 days. Is that something I'm just imagining, or is that something you've seen?
No, not at all. They're actually non-correlated. Sometimes you'll see that. It depends on the positioning of the managers. If they're positioned in a way that where the trends, it depends on their trend speeds. Sometimes if they have a shorter trend speed, they might be able to. That might be the case. It just depends. Like DBMF, for example, their trend speed they're really not focusing on trend speed. They're actually trying to match the overall trend speed of all the CTA managers. Whereas CTA, on the other hand, they have a blended, really short-term trend speed, medium, and longer-term trend speed, and so that gives them kind of a broader effect. Their correlation, I want to say, is something like to each other is something like 0.53 or something, even though they do the same thing.
Do you find technical analysis works with these kinds of funds?
No,
Okay,
I really don't.
wondering.
The reason why is because there's not a support and resistance supply and demand issue with regard to them, and they're both long and short. I mean, you could. I mean, I'm sure you could do some something with that. They tend to be mean reverting, and they tend to be very asymmetric. So they tend to do nothing, do nothing, do nothing, and have a big move, and then do nothing, do nothing, do nothing, and then have a big move. That's what trend following is, because it's a volatility expansion type of strategy. So it's not a convergent trade where you're making money when things kind of settle down. It's more of a things are changing, trends are getting big, and you're just jumping on them. So I wouldn't if you were going to do something technical, I think it would be more mean reversion, not trend following, not like traditional breakouts and things like that. But I don't know. I could be wrong.
Louis, would you say, so when I built the Fear and Greed Index, one of the things that I did is I tried to use relationships between different ETFs, right? Different indexes effectively. So as you're talking about these managed futures funds and saying that they're only going to do well in certain market types, right? High volatility markets, you could actually build some sort of an indicator around these, right? Like as you're thinking about what kind of market are we in, these things might be giving you a bit of a clue as to what's happening in the market, and that you might be able to use that as an indicator for what may happen next in a more traditional asset class like stocks.
Yeah, yes, and I guess I should probably modify what I just said about technical analysis. You can't use it. I guess you can, because the way I picked it, buying it, was that every time when the market gets lulled into the belief that the stock market's going to go up forever, that's when you want to buy them. And that's why I bought them, and I started buying them a couple years ago. And and as you know, I've actually managed that strategy. I know that I'm very intimately, and I very
Right.
intimately understand that strategy.
Yeah, exactly. Well, this is really interesting, but I think I want to move on to a couple of questions that are a little bit more equities focused. So I think we've established that everybody is kind of bearish, but maybe becoming a little bit more bullish as valuations start to become more reasonable. So I want to ask what each of you is looking for to identify a market bottom, and do you think that we're going to have something that looks more like a V bottom or like an L-shaped bottom? And so let's just continue in order of tenure, starting with Bob, moving on to Sarge, and then Louis. And feel free to interrupt each other and ask questions. And let's hear what you think, Bob.
So over the past 7-8 weeks, the stock market is making a series of lower highs, lower lows. That is our textbook definition of a downtrend. And until that stops happening, so we get some ascending patterns that get built over the next few weeks, I'm not going to be convinced that we've hit a bottom yet. I know bottoms are always fun and exciting and thrilling, and if you catch that bottom, and I've always preached that trying to catch tops and bottoms is a loser's game. As a trader, as a momentum trader, I really I don't care what the bottom is and what the top is. I just want to trade the middle. That's where I make the most money, and that's where I make the better money in trading this market. So to answer your question, it's hard to say where a bottom is going to be. There's a lot of support down lower than where we're at right now. I'm looking at it right now. Apparently, some news came out while we were talking a bit ago. I think when Louis started talking, apparently the president of the head of Iran wants the war to stop, but he wants guarantees. So the futures popped on that quite sharply. So you guys take a look at that. We were up about 170 handles and then 140 from the. We popped it quite a bit. So the market still is moving on news and moving on headlines, and when that stops, that's going to put us in a situation where we can evaluate the markets a little bit better than we can right now. As right now, it's a guessing game. I'm much like Sarge. I'm sitting in a lot of cash right now because, my ability to guess up or down is no better than anybody else. It's a flip of a coin right now. And if you unless somebody's shooting me a phone call and telling me that something's going to be disclosed in about 10 minutes. So
you're not on that list, Bob?
No, I don't have the red phone like Batman had, but
Yeah.
I don't have the hotline. So I think that I think Louis might agree with me that you get a nice base building period for the markets once that low is established, and then you start seeing some patterns of higher highs and higher lows, and then you've got something to work with to go back up. Sharp moves up like a V bottom are going to turn into what's called a W pattern, hopefully, which means you come down, you make an interim high, and then you come back down, test that or interim low, make it come back up, make it test that low,
Right.
and hopefully carve out the right side of the base and move back up again. But that's asking a lot. That's asking several things, not just V, but it's a W. If those things work well too, but it's going to take weeks and weeks and weeks. We're going to finish the month of March, even though we're strongly today, finish strong. We're going to finish the month of March down, and the MACD on the monthly chart is going to cross over for a negative signal. So if we have another down month in April, that's going to set this market up for a bear market. As much as people won't like to hear that, that's what the technicals are telling me.
All right. In the interest of time, let's move on to Sarge, and we'll try to start wrapping this up. But yeah, Sarge, let's hear what your thoughts are.
All right, not much different than Bob's. If there are rumors that Iran's looking for a way out, that would greatly accelerate our finding a bottom in the stock market. In fact, if there is some kind of deal that comes up this week, the bottom's in. As far as technical, I've seen since early to mid-February. I guess we had the initial sell-off in early February, but my identification of an initiation of a bearish trend started around late February. I've had 4 confirmations or reconfirmations of the trend that I've identified since. Today's update, obviously, but we would need to make a run at the 200-day simple moving average in order to feel better about the technical situation, in order to get portfolio managers involved. On the daily MACD, we need to see the 12-day EMA, exponential moving average, move above the 26. We need that before we even know that we have something in hand. Maybe if this good news holds today, we might see that tomorrow. And going into a holiday weekend on light volume, that could accelerate any kind of recovery. So it's easy to get carried away right now and think maybe there's something's happening, and maybe it is. That's a good thing. But I would still be a little slow going into this longer weekend unless we have hard news.
Okay, sounds good. So caution reigns supreme right now. Louis?
I don't have that much more to add. I mean, let's just say a classical technical view would be it's near some serious moving averages that everybody looks at. It's bounced a little bit off of that. There's role reversal support that a lot of people are looking for. You'll probably have some buyers step in there. You have rising volume on the way down. Today it looks like it's putting together something like a hammer type pattern, but those are only reliable. I've done a lot of testing on these hammer patterns. Those are only reliable to the extent that you have a little short-term move, 2-3 days. So it doesn't mean the trend is reversed. And then the other thing is that we have this thing where you look at it's called translation to the right or translation to the left. Basically what it means is when the market's moving up and down, if it's moving for a longer period of time up and then comes down really fast and then goes a long time up and comes down short period of time, that means it's translated to the right. That's bullish. We're starting to see shorter periods. This is the first wave that we have that's shorter. And so that to me is a kind of an indication that it's not like ripping, roaring type bull environment in my mind, especially when you put valuations on top of that. But to me, if you just have rates drop, I think that will just change everything. Mortgage rates by the way, have clicked up quite a bit, and that'll throw us into a recession if those rates go up. Because I mean, they were at 5.99 on the 30-year. Now it's at almost 6.5, 6.49, I think. That's enough to throw people, and that happened very quickly. We have to see. It's really hinged on those 3 things that I was mentioning in my mind. As far as I can see. So it's hard to know. That's why I don't try to time that unless I'm tactically moving into something that I want to move in longer run.
Okay.
So
yeah,
I don't know if that helps.
Yeah, no, that helps a lot. I think that's a great way to think about the markets is that getting back to my question of V or L, we'll know in the fullness of time, and we can't really predict. We should react. So with that, I'm going to ask you a prediction question. Each of you, I asked you just for for a favorite stock pick for right now, and that can be long term, short term, whatever. It's up to you. So Bob, and again, long term, short term, or long or short, bullish, bearish. What do you got?
Well, I did mention I like energy. ConocoPhillips is one of my favorite ones. They do a lot of business in the Middle East and even in Venezuela as well too. So ConocoPhillips long for me. Also, I would tell you, I'll give you a bonus one. Costco, Costco, COST, it's been a very, very strong stock this year. I like to gravitate to strength when it comes to individual stock selections. So this is probably one of the better names, performed well during the market downturn. I think the stock is back up over 1,000. They have an incredible business model with the memberships, and we're just lapped the period where they the whole year, and they had their last price increase. So all systems go for them as long as they continue to battle and keep product in the store. And every time I go in the store, I mean, I don't know about you, Sarge and Louis and Jason. Every time I go into the store, it depends, doesn't matter what time or what day it is of the week. There's always a long line to get out, and
Yeah,
especially
there
at the hot
really
dog
is.
counter. And
Exactly.
So,
Costco
so I mean,
is a
I
force
don't
these days.
absolutely. So those are my two.
Yeah, great. Sarge?
Well, my picks won't come as any surprise to anyone. Okay, I am buying SoFi with my own money. I am buying SoFi for the $10,000 portfolio. I believe that Muddy Waters, the threat posed by that report, is probably a bit overblown. I do believe that Anthony Noto will be vindicated because the kid's a West Point guy, he's an infantry guy. If he goes down, I'm going to be hurt. And I'm putting my own money behind that. And that was my stock of the year for 26. I got punched in the face a couple times in the first couple months, but I have been adding here. And second is going to be my stock that's been my stock of the year for the couple of years prior. And that's going to be Palantir. Palantir has proven their worth. Now, a lot of people might not like this, and this may be controversial, but without Palantir, we could not have destroyed an enemy without putting boots on the ground. All right. Now, maybe a lot of folks don't like to hear that, but Palantir gives us an advantage. It gives the Western nations, it gives the United States and Israel an advantage over their enemies. And right now, there's nobody close. And when Alex Karp says that they don't really have competition, they don't really have competition. Not yet. That competition will come along. But right now, I think you'll see a rebound in Palantir as we move past this war, because basically every friendly to the United States nation on earth is going to need to spend money on Palantir's technology.
All right. Two great picks. And again, for readers, you write about both of those picks a lot. I would say last couple of years, Sarge, you were known as like the go-to guy who was not a traditional Wall Street analyst who was following. You were like the independent voice around Palantir, and I know that a lot of people appreciated that. So
he was the
yeah.
Palantir whisperer.
The Palantir whisperer, exactly. All right, let's move on to Louis.
Oh, well, you guys took a couple of my picks, so I'm a little bummed out. It's okay. I do like the energy, by the way. I have right now I own VLO, Valero, Chevron, and EQT. I think I only wrote about Valero, but I like that particular basket of stocks. And I also like Palantir. Just a little quick story. I actually have owned a lot of Palantir in portfolios, and I actually had this client call in and had to talk to me. So got through to me. It's like, I need you to sell this Palantir. I don't want to own Palantir. And it was all political. It's like, well, it's like, do you want me to just like make you money, or do you want to be political? I don't know. Anyway, so that does happen in my world. You guys don't have to deal with that as much as I do. But I'm going to throw out something a little bit controversial. I like Oracle. I think Oracle is beaten up. I think that company will revive, and this is longer term. I think that you could start building a position. I have clients that work there, and I know that the way they time things. I really think the SaaS thing is a little bit overblown. Yes, there is we're able to code things faster. There's a lot of firms are building things on their own. That is a real reality. But there's also this huge switching costs a lot of the larger firms have. But I think Bob, you were talking about building a base. You look at Oracle, it's come down. It's probably trying to build that base, and I think you can accumulate it as volume shrinks, and people just forget about it.
Awesome.
So,
Hey, Louis, can I ask you about Oracle?
Yes, sir.
You can, and I kind of like that name too, but I'm stopped by the balance sheet. The remaining performance obligation is enormous, yet the deferred revenue on the balance sheet just isn't there. Do you see that? Does that cross your mind? Do you think about it?
I do think about it. I think that they're going to work through it. It's a little bit hard to know exactly. I've been tracking Oracle for a long time, and I'm amazed at how adaptive that company is. And there's certain things that can happen that will. I'm not an expert in that particular part of the accounting, by the way, so you probably know more about it than I do. So I'm looking at it from a more of a longer term perspective, from the way the chart is acting, as well as what the company is actually doing. And I don't know, but I suspect that what they're doing is going to be able to manage cash flow correctly in a way where they're not going to go to zero. I think that what you're talking about is one of the worries that is weighing on the stock. And but what I would like to see, by the way, with Oracle is a catalyst, a technical catalyst, to prove that I'm right. So I can't tell you how many times I've sold a stock or a stock looked cheap, but it was super expensive, and then a stock looked expensive or had problems, and then it bottomed out. You know that. So I just don't know the timing of it. But I think if you were to say, okay, what's Oracle going to be trading out at in like 2 to 3 years, I think it's going to be higher. And that's kind of my time frame with some of my money. So it's not a trade.
So Louis, let me ask you a technical question on Oracle here. So you probably remember back in September last year when they reported their earnings, they gave some sort of 5-year forecast of revenue. It was ridiculous, right? Nobody does that, but Oracle decided to do that. Safra Catz came out with a huge forecast of huge revenue coming from AI, and the stock just, it went up 80% in about, I want to say 80% in about a few weeks, right? At the time before they reported that, the stock was around 230, roughly. Now it's 138, but you look at the 200-day moving average, it's only 220. So I think you're right. I think probably the fair value for the price of the stock when it comes to it on a technical basis is probably closer to the 200-day moving average than it is where it is right now, right? Because if you look at that, if we stock moves just back up to the 200-day moving average, that's probably about a 70% return from here. I think that that's probably where most people believe the stock would be fairly valued. So I can see what you're doing, and if you're taking a long-term perspective, I really think you're going to be right. I think it's a good call.
Oh, thanks. There was a technician. There's been several technicians that I've met, old timers, Ralph Akampora, Shaw. What's his first name? Alan Shaw. Alan was like, get your ruler out. I wish I could show you the screen. You just get your ruler out and you look at that trend line. It's like, okay, still downtrend, but we could have a little bit, we did have little bottoms there that show potentially that it's slowing down. It'll be a while before the fundamentals turn around. But one thing I do know is that the companies that are contracted with Oracle are so entrenched with their software, it's like virtually impossible for them to just unload Oracle's products. Will they charge less for it in the future? Will they have lower margins? Potentially, but they're also adapting extremely rapidly right now. They're really trying to do some things, and I've seen them do it several times. So we'll see. See what happens.
Well, guys, I think we should wrap it up here. And I hate to do it because I'm enjoying this Oracle conversation. And I wonder if there's some format here that we should be thinking about where we pick an individual stock and we discuss some of the positives and negatives around it. But we'll have to think about that down the road. For now, I just want to say thank you to all of you and to our listeners and our members and everybody for supporting us and for enjoying the conversation. I know I did, and I look forward to more. And Chris Versace will be back next week. So with that, I'm going to say thank you very much.